Welcome to Achieving Your Successful Business Exit 101, 7 Things You Must Do, a free webinar presented by Basecamp 4. My name is Jeff Cullen, and I am the sole consultant and proprietor of Basecamp 4, a boutique consulting firm that specializes in working with small and private sector companies to overcome growth barriers and achieve successful owner exit. I'm a certified exit planning advisor with the Exit Planning Institute, and I have worked on and completed over a dozen exit and transition engagements over my 20 plus years as a management consultant. We're going to start with a little interactive poll through Mentimeter. So if you've got your cell phone handy, there's a QR code that you can access the poll, and then we'll sort of go through that. Then I'm going to get into the main topics: why exit planning matters to you, 7 things you must do as promised in the title of the webinar. And we're going to talk a little bit about what you need to know about an effective plan. What is an effective plan? What does it look like? Then we're going to run about a 10-minute QA. So what I'll do is we'll defer questions till then, because I said there's quite a lot of material, and some closing remarks. I've run through it about 5 times, and I'm able to pull it off in about the 60 minutes as promised. So hopefully we'll be able to do that.
Yeah, and if you have any questions, just put it in the chat.
Yeah, my friend Mark and co-host of our podcast is helping out this morning. So if you want to just go to, you can either go to menti.com and enter that access code, or use the QR code on your phone. We'll take you right over to a 2-question poll, and I'll just pop over to that screen here in a minute, but I'll give people a chance to grab the QR code here. Hopefully everybody's had a chance to get it. We'll do another minute or so, and then we'll pop over. Everybody got it? Okay. Just grab and share there. Screen again. Okay. And just maximize that. Okay, here we go. Okay, so we have roughly a split between I am confident I will succeed in exiting my business when the time is right, and I'm not sure, and nobody has said no, so that's probably a good sign. And then if we look at the second question, which is I have a plan for my future exit, you can go ahead and vote for that one. A couple people plan in my mind. That's good. Okay. yeah. I'm not surprised. I'll just give another couple seconds here and see. All right. Well, go back to the results of the first poll. Like it says, about an even split between yes and I'm not sure. And here we see kind of a grouping around a plan in my mind and a plan, you say. And, I have to say this is very consistent with a lot of the research data. And we're going to go over very quick overviews of the research data, but this is not atypical. So most business owners have an awareness the future is at some point coming, and they know it's something that they need to think about. but they have not necessarily had the opportunity or the resources or the time, quite honestly, to really start to put something on paper. And as we sort of see in this first one, I think there is a fair amount of confidence that people have that they will exit successfully. I don't want to necessarily dissuade you of that belief, but I think I want to educate you and give you an opportunity to understand that, yes, that's certainly possible, but there may be some things that, not maybe, there's definitely some things that you're going to need to do to maximize that opportunity. So I will just pop back to the PowerPoint and we will get back on it here. All righty. Okay. So why does exit planning matter to you? Well, if you're one of the advisors on the call today, and I'm certainly glad that there's a number of advisors that have joined us, it matters to you because it's going to matter to your clients and it's going to have a significant impact on their ability in the future to reach their goals. And then, of course, because most of us care about our clients, we're going to want to make sure that they get the best outcome possible. And if you're a business owner, it's really going to matter to you because a lot of your future success, security, and peace of mind is going to be contingent on how effectively you're able to exit your business. So like I said, there's a lot of interest in exit planning. I mean, this has been around on radar for maybe 12 or 15 years. But recently it has reemerged as something that's very top of mind. And so many entities are spending significant resources in doing studies and polling owners. Business Development Bank, Exit Planning Institute, all the major banks, the big consultant firms. You just do a Google search on exit planning research and you'll find tons and tons of data. And because I've read a lot of it, what I've done here today is I've just distilled it down to 3 really important facts that I think capture the main message. The first one is that statistically speaking, only about 10 to 20% of owners are going to successfully achieve an exit. Now, success, of course, is a subjective term. Success is unique to every single owner, but generally speaking, what we see is some pretty strong trends that are leading to about 8 out of 10 claiming that they don't feel that they have successfully exited or transitioned. The number one is failure to sell or transition at all, or if they do, at a much lower value than they anticipated. So obviously that is a major stressor for people. The second one is the time and effort required has far exceeded their expectations. So again, consider that most business owners, you don't go on vacation when you start exiting your business. You're still running the business. You're still trying to maintain profitability, perhaps even increase the size of the company, hit some growth. And at the same time, you are attempting to stick handle an exit. So a lot of owners find that it becomes almost unmanageable in terms of, you've got now a second job. The third main driver of this high level of dissatisfaction is the degree of post-exit involvement, including sometimes financial. In other words, how long it takes to actually get the money out of the company that is greater than they had originally desired. So a lot of owners are just finding that if they exit at all, it's certainly not what they would deem successful in terms of what they'd wanted. The next big stat is that even amongst those who exit and manage to have a satisfactory financial settlement, still 3/4 of them express remorse within 12 months, which is a huge percentage when you think about it. So the 3, again, main reasons that we have found in the data, failure to secure and keep the value or the deal they felt was fair or needed. So that could be a combination of feeling like they left money on the table. Even if they have the money they need, they may still feel a certain amount of dissonance that maybe I could have got a better deal, or the deal structure, or in some cases, because they have not successfully positioned their personal affairs, they wind up not keeping a lot of the proceeds, right, through tax and other expenditures. So that is a major cause of dissatisfaction. The second one is ill-prepared for life after ownership. So we're going to talk more about this in the second main topic, but anybody retires finds that there's a major adjustment. And for business owners who, let's face it, are a different breed, to suddenly find yourself totally upended in terms of what are you going to do with your days, just, value that you bring, like, who are you basically, is a major cause of dissatisfaction. And then the third one is they often are unhappy with what happens to their baby, right? You've built this business. It's been a big part of you. You have relationships with staff, customers, vendors. Sometimes people are dissatisfied when they see the new owners come in and make decisions that certainly would not have been what they would have chosen. I mean, again, picture maybe the day they take your name off, the building, right? So again, not that you can necessarily control all of that, but being prepared for it, even psychologically, is a pretty important step to, again, reduce that seller's remorse. And then the third big fact, which ties to economics and demographics, is that many owners will be facing a buyer's market. So like anything else, selling your business is subject to the laws of supply and demand. And when supply outstrips demand, there's downward pressure on the prices. And we are going to be seeing a huge increase in supply. It's the demographic tsunami that people have been talking about for years. Yes, perhaps it's been delayed a little bit because of COVID, and there's a number of business owners who either feel that they're not ready to exit and they're hanging on, or hoping that they'll be able to recover some of the value. But regardless, we're going to be seeing, just by the pure fact of demographics, a huge number of owners are going to be exiting. And in terms of order of magnitude, way back in 2018, PwC estimated that about 816,000 businesses, which represents about 63% of the 1.3 million private companies in Canada, would be changing leadership or ownership in 5 years. So obviously, like I say, some of that's been delayed, but there is going to be inarguably a huge amount of businesses coming onto the market or attempting to transition. And it's not going to be the same experience for everybody. So again, industry data shows that for those companies that are highly prepared to exit, it's going to be a seller's market to a certain degree. There's going to be high demand for those high value companies. But for those who are poorly or not prepared to exit, it's going to be a buyer's market, or in some cases, no market at all. So, conclusion, preparation is key. And yet, Canadian Federation of Independent Business, another organization that has spent a lot of time looking at this, when they did a survey in 2018, found that only 8% of owners in Canada, or of their polled members, had a formal written plan. 41% had an informal plan. And again, if you look at our poll, which could be anything from I have an idea in my mind to I've got maybe some post-it notes, and 51% no plan at all. So the question that you have to ask yourself is, where do you want to be on that pyramid? Do you want to be up in the seller's market, or do you want to be down in the buyer's market? And I think the answer is fairly obvious. Okay, going to move on now to the second part of the webinar main content, which is, as promised in the title, 7 things you must do to prepare and succeed. Why 7? Well, there's a lot of things that a business owner has to do to prepare and succeed, or that you as an advisor need to help your owners with. These 7 are kind of touch on all the fundamental parts. And honestly, if you do these 7, you're probably going to cover some of the minor things just de facto. And so that's why I chose these. Number 1, know the value of your business and your 3 gaps. I'll gloss on this over quickly, but again, the survey data shows that about 80% of business owners do not have really any good idea what their business is worth. And when they're asked to estimate what they think the business is worth, historically or traditionally, they overestimate the value quite significantly. The thing is, though, even if you know the value of your business today, that's certainly a good start, but it's only one part of the puzzle. So I'm going to take you through a little example here where we're going to talk about a couple of key numbers. The first one is, how much will you need to fund your future, right? Knowing what your business is worth today is good, but really the question you need to answer is, how much am I going to need at the future? What is the value of your non-business assets? And what is the difference between those two numbers? And it's what we define as your wealth gap. So let's just run a quick example. Let's say that you work with your financial planner and you decide that post-exit, you would like $300,000 in net income. And again, we're just using, rough numbers. We're not going to talk about tax. As you go through the process, you would clean that up, but strategic level numbers. Okay. So you determine, yeah, my lifestyle, what I want, 300,000 net income post business. We apply sort of a standard formula, divide by about 3%, and you get a $10 million estimate of that is the capital that you're going to need to have to fund that post exit lifestyle. Let's assume that your non-business assets are worth about $2 million, property, investments, some toys, some collectibles. That gives us a difference then of $8 million, which is what we would term to be the wealth gap. Because we're talking about exit planning, what that really means is that you need to extract or harvest about $8 million from your business at exit. Okay, what's the business worth? And what will it be worth? So we're going to look at three more numbers now, and we're going to look at a formula for strategic valuation. Those on the call who are accountants will tell you there's lots of different ways to value a business for different purposes. We use strategic valuation because, first of all, it's a fairly simple calculation, and it's kind of how a third-party buyer is likely going to value the business as well. So there's a relevance to the real world situation. So you see the formula here: strategic valuation times normalized EBITDA times an industry multiple. I've already kind of defined the strategic value. Normalized EBITDA is your earnings before interest, tax, amortization, depreciation, and adjusted for irregular entries. So again, the reality is everybody runs their business a certain way. What we then tend to do is we'll take the income statement and we kind of clean it up. So a good example might be, maybe you're paying yourself $1 million as a CEO. And if you are, way to go, that's awesome. But a buyer is not likely going to pay a CEO $1 million. So what they would do is they would adjust that to, let's say, market value for a CEO. Let's say it was $250,000, right? So we would adjust that compensation down to what we would expect to see in the market. We would do that for all kinds of anomalous expenses, and maybe there's some income, from a research grant or something. We just want to normalize it and come to a number that is kind of what we would expect an average company. The last number is the industry multiple. This is a specific data point that represents, on average, how many times a business in your industry and roughly your size would be selling. Obviously, that changes over time with market conditions, and we would be updating that number on a regular basis. Here's the thing, though. A single point valuation is really representative of a range of values. And we know that within a sector, businesses are going to trade along basically a normal distribution of the values. And it looks something like this. So let's say that the average in a particular industry is 4 times the multiple. What we know is that based on the attractiveness, the readiness of the business, how systematized it is, certain businesses are going to trade at a lower range, what we would call sort of very weak. And the best in class businesses, the premier businesses, are going to trade at a much higher range. And typically what we would see is that at a certain point, you actually enter the no sales zone, right? Businesses below a certain readiness and attractiveness score, how a buyer would view the business from outside, and then how ready the business is when they come in and start doing due diligence, actually going to fall off the scale and probably not trade at all. And then the other ones are going to, as they get better and better position, we would expect to see higher multiple. So what that looks like in terms of the spread is something like this. Let's assume that we have a normalized earnings about 1.5 million, 6%. As a company increases its attractiveness and readiness and the multiple goes up, you can see that there's a significant increase in the strategic value. The difference between where your business would be today, where we would value it, and where it might be, we call that the value gap. So recalling that we had identified $8 million as our wealth gap, that we need to extract $8 million, this tells us that we would need to be trading above average and somewhere, slightly below that first cutoff, right? So it gives you a target. The thing is, though, there's even better news, because honestly, a company that is operating at the higher range near best of class is likely going to have higher earnings as well. So if we assume that instead of the 1.5, the company is able to earn 2.4 EBITDA with the same revenue and multiply it by that top level multiplier, we now come up with a strategic value of 18 million, which means that you could, in theory, add $10 million more value than you need to close the gap if your business is operating at or near best in class. So, I mean, these are not insignificant numbers, right? One final idea around the value: business profit does not equal business value. The reason for that is you could have a very profitable business, but it may have no value or very little value once the owner is removed. However, a valuable business will almost always generate higher levels of profit. So value should lead and profit should follow, right? And I mean, certainly there are businesses, I think we like to use the term lifestyle business, where, an owner is extracting a fair amount of proceeds in the present. And of course, that's awesome. But you have to ask that question: post-exit or at exit, what's the business going to be worth? All right, that was thing one. Thing number two: have a personal plan for what's next. So net worth and self-worth tied into the business. We know that on average, according to the statistics, that 80 to 90% of most business owners' net worth is tied up in the business. But the question we're asking right now is, how much of your identity, how much of your purpose, how much of your self-worth is tied up into the business? In other words, what's the answer to the key question: who will you be the day after you exit? We know that this is a major contributing factor to seller's remorse. Not having a clear picture of who you're going to be, what you're going to do, leads to, a great deal of discomfort and regret. So there's a lot of ways to answer that question. I'm just going to share with you one model I found that I do like. It's called the STEP model. And, it addresses 4 key dimensions. Spiritual: what's my purpose? What's my passion? What's my why? What do I want to accomplish in the world after I exit my business? Things: what do I want? What do I need? What am I willing to discard? Maybe you want to buy a collectible vehicle. Maybe you want to buy a football team. Maybe you're going to be selling a lot of your properties and liquidating, and that's going to have an impact on how much money you need. But again, you got to think that through. What kind of experiences do I want to have post-exit? Do I have a bucket list? Are there dreams that I've always wanted to fulfill? Or maybe I feel that I need to make amends to certain people in my life because I've been so busy running my business that maybe I've neglected certain parts, and now this will be a time to kind of rectify that. Speaking of people, who are you going to want to spend time with? Are there people that you're going to want to thank, maybe help? Are there people you're going to want to avoid, where you're like, I've spent my whole time as an owner dealing with these people. I don't want to deal with those people anymore. Again, the idea here is to have a reasonably clear picture so that you're not waking up the day after you exit going, now what? And this requires time and connection. You've got to invest the time in answering these questions. Number 3, can I create a business that can thrive without you? So we know that a potential buyer or successor is going to ask 2 questions. Certainly a sophisticated one will. How much risk exists if the owner exits unexpectedly? And what value will remain in the business after the owner is gone? So a big part of the exit planning methodology is to reduce risk and transfer that value. Let's talk about value for a second. Where does the value come from in the business? Well, historically, it would have been tangible things in the business. And these are usually well captured in our traditional financial statements. Physical assets, land, resources, equipment, plant, human and machine labor, all of that we do a pretty good job at capturing. What we know now, though, is in a modern economy, a lot more of the value is in the ability to create and transfer and exploit knowledge assets, right? So the physical stuff, yes, it still counts for part of the equation. The intangibles are a much more significant part. And I can prove that to you with a little stat here. So back in May 2020, Shopify became the most valuable company, publicly traded Canadian company, and displaced the RBC, which had been kind of there for decades. And the interesting thing here is you look at the number of employees and the value of the fixed assets of the two companies, and you look at it on a sort of per capita rate. Shopify, was able to create $24 million in market cap per employee compared to about 1.5 for the RBC. And it gets even wilder when you look at that market cap to fixed assets, $162 per dollar of fixed assets versus 64 cents. So there's some reality, pardon me, in this idea that you have to capture the intangible value and transfer it to the business. So how do you do that? Well, there's 4 areas of intangible value. We call them the 4 C's. Human capital, this is the talent that resides in your team. And I like this little equation. Human capital is equal to ability times commitment. Customer capital, the nature and the strength of your customer relationships. So how many customers do you have? What is the percent if you lost a major customer? Would that represent a significant chunk of your revenue? And what's the risk of that happening? Where do you fit in their value chain? Are you an indispensable member of their value chain, or do they view you as a commodity that could easily be replaced? The nature of those relationships, is it long-term and recurring, or is it more transactional? And who owns that relationship? Is it the owner? And once you remove the owner, a customer is no longer sort of tied to the business, or do they actually have an embedded relationship with the business? Structural capital. This is all the infrastructure of the machine, right? Your processes, your procedures, your policies, intellectual property, how you use technology, knowledge base, right? So you've been in business a long time. You know what to do, what not to do, what errors to avoid. You've got history, you've got data. All of that, if it exists only in the owner's mind, has to be extracted and codified so that when the buyer comes along, they can carry on as usual. And finally, the social capital, the social operating system of the business, what you could call the soul or the secret sauce. What makes the business more than the sum of its part? The culture, the climate, brand equity, social networks, the style of communication, the rhythm, the vibe. Again, super intangible, but really, really important. Thing number 4, give yourself enough time to succeed. So basically, you're trying to accomplish 3 things. You want to build value in the business. You want to align and prepare your personal affairs. You want to maximize the attractiveness and readiness. When the BDC asked a bunch of owners back in 2017, how long did they think it would take to exit the business successfully? You can see that a significant portion thought, 1 to 2 years, maybe less than a year. And, small numbers said, 5 years or more. Is that right? No, it's not. A more realistic timeline for exiting is what we see here. It's about a 3 to 5 year process for pre-exit preparation and positioning. And then about 5 to 12 months, even after you initiate the sale or transition, of due diligence and negotiations. So we're looking at, 4 to 6 years realistically. And then there's a couple of things. In a family-owned business, usually we say the pre-exit's a little bit longer because there's some dynamics there that are unique. And you have to also consider post-closure, things like earnouts or other conditions that might extend your involvement. So, people who think that they're going to be able to exit in 6, 8, 10 months, probably not realistic. In fact, I will say definitely not realistic. It's more 3 to 5 years and then some closing time. So be prepared. Speaking of preparation, preparing and guarding against the unexpected. So maybe you're thinking, Jeff, this is all good, but you know what? I love my business. I'm going to be in my business until they carry me out. And then, other people can worry about it. And hey, if that comes to play and that's what you want, then I say more power to you. But realistically, the stats demonstrate to us that 50% of business exits are involuntary and driven by adverse events. 50%. So despite the best plans of a lot of owners to, stay at the helm until the very last minute, 1 out of 2 of them is going to wind up, having to exit before they wanted to. And the main reasons behind this, we call them the 5 Ds. Again, not things that a lot of us want to think about, but again, it's kind of like life insurance, at your own peril. Death, disability, divorce, disagreement between partners, and distress to the business. Any of these can strike without warning and put the business at risk. I mean, forget about the exit. The entire business can be at risk. And they elicit some specific, very important question. Who's in charge if the owner becomes incapacitated? Is the owner's family taken care of, right? We see all kinds of situations where once people start, the dust settles, there's just a lack of clarity. Is the business going to be tied up in court in the case of a messy divorce proceeding? And what impact will that have on the business's ability to carry forward? If we're having disputes, can we resolve them using the unanimous shareholders agreement? Do we actually even have a USA? What if there's a significant economic downturn or unexpected losses, right? Fire, key personnel that get either leave or there's some kind of incident, data breach, all of these things can put the business at risk. And so early stage in the exit planning process is to identify these risks, de-risk, and then document contingency plans so that when something happens, if something happens, we've already thought it through and we just put the plan into stage, as opposed to, the classic, oh my God, what are we going to do now? And remember, when these things hit, the business owner and the family and all the players, they're not at their best, right? They're dealing with some kind of incident. And on top of that, having to figure out, what are we going to do with the business? It's not always bad adverse events. Sometimes it can be good. You might get that unsolicited offer that you feel you can't refuse, but you got to remember, those offers are typically time limited. They're still subject to due diligence and buyer scrutiny, and the viability and the value of the offer will be contingent on that attractiveness and readiness. So there's an advantage to preparing early. So like the old Boy Scout motto says, be prepared, be prepared, be prepared. Number 6, selecting the right option for your exit or transition. Again, this is super critical. Every owner, every business, and therefore every exit is unique. It's going to be based on the owner's financial needs, the timeline, your future plans, what kind of legacy do you want to leave in terms of personally or for the business, personal and family situation. You may have children who are extremely interested in taking over the business. You may have children who want nothing to do with taking over the business. Health considerations, right? Again, we all, I think, tend to expect and hope that we'll get into our senior years, spry and able to do whatever we want. That's not always the case. And then what's the nature and the state of the business? So, pardon me. There's generally 7 options that are available. There's really 8, although the 8th one is pretty rare for mid-market businesses. Rarely would you do an initial public offering, so we're not really going to worry about it. 4 of them are internal, 3 of them are external. Intergenerational transfer, so transfer to family or children, management buyout, sale to existing partners if you are in a multi-owner situation, sale to employees through something like an ESOP, pardon me. And then 3 external options, sale to a third party, whether it be a strategic buyer or an investment buyer, recapitalization, which is maybe you don't really want to leave the equity pool, maybe you're not ready, but you like to take some chips off the table, find an equity partner who can come and buy a portion of the business, recapitalize it, provide maybe some energy to grow, and then ordered liquidation, which is basically maybe you've decided to just terminate the business and sell off the assets. The thing here is that there's no right choice for across the board. Every owner is going to pick the option that is best for them, but you have to give it some thought. You have to plan for it again, because the pros and cons need to be weighed, and each option is going to impact other parts of the plan, valuation and timing, what you're going to do with your leadership development. If you're selling to a strategic buyer who really have their own management team, it's not as important. Your personal estate and tax planning will be impacted by the choice, and then your future role and involvement. Excuse me. Maybe I should have been drinking gin. So again, preparation is the key. Final of the 7 things is using a coordinated team of advisors for each step. Exit planning is complex. It can be, and it can be time consuming, and it's easy to get lost. Doesn't matter how smart an owner is. If you've never done this before, it's new. It's unfamiliar territory, and there's a lot of moving parts. The most effective exit plans have at least 3 parts. We call them the 3 legs of the stool. The personal plan, we've already touched on a little bit, for what's next for you as an owner and for your family. Your financial plan, that involves all of your personal affairs in terms of estate planning, your investment strategy, your tax strategy. Maybe you want to be doing some charitable giving, you name it, right? But there's a lot of parts there. And then the business plan. How do we create that value and position the business for sale? So you're going to need some help. At a minimum, what we find is that you would bring in at least these players and maybe some other ones. So an estate planner, financial planner and wealth manager, lawyer, accountant. And the accountant then can bring in evaluators or tax specialists, a risk advisor to help you understand insurance strategies that may be advantageous, and again, to protect what you've got as you get closer to the actual triggering of a sale or transfer, an M&A advisor, a business broker, and then possibly a family advisor, whether it be a family business or just the fact that the changing of the business is going to have an impact on the family. And then a value advisor / exit planner. And I like to put them close to the owner, because as we'll see later, having someone who works with the owner through the entire process actually creates a lot of benefit. So the common theme across all 7 of those things, I think you probably will agree, is proactivity. Be proactive. Very little can be accomplished at the 11th hour, and your options become limited. So any broker that you talk to, I'm sure will be happy to recount how many owners they come to them, and they have to break the bad news to them that really not much to sell in this business. And I've talked to some myself who, they knew they should be planning, they were busy, and now they maybe have had some kind of adverse health incident. They want to get out of the business, they need to get out of the business, and yet they're just woefully unprepared. And that's probably one of the biggest regrets. I wish I'd been more proactive. Okay. Now we're going to talk about the third part before we move on to the Q&A. What does an effective exit plan look like? So hopefully by now I've convinced you at least to start to consider, I think an exit plan beyond a bunch of pieces of paper or what I have in my head is probably a good idea. But what does that actually look like? Well, there's 3 key ideas to take us from I need a plan to I have a plan. And the first one is that exit planning is actually planning for growth. They are not separate things. The next one is that exit planning is a process, not an event. It's not a thing that you do, one day and go, okay, let's hammer out an exit plan. And that you coordinate your advisors for successful outcome. Let's talk about the first one. Growth is critical. So BDC surveyed a bunch of potential buyers back in 2017, and this is pretty consistent. And what they found is that buyers, 61% said they want stability, 31% said they actually want active growth. I think stability is kind of a hard thing to achieve. If you actively try to keep your business at the same size, things happen, you're likely not going to grow. So I would say that growth is probably de facto the safe option. And yet 48% of owners, when I'm surveyed by the BDC at the same time, only 48% wanted pre-exit growth, and 28% actually expressly said they did not want to grow the business before trying to exit. They didn't want to invest the time and the money. And that's a strategic error. But there's some good news. The value acceleration activities, the transferring of the value from the owner to the business, you can do it at any time, and you're going to get that additional value. So you can do it after that initial growth stage of your business and you start to hit that natural flattening out. You can do it then, and you can do it later on within that 3 to 5 year a window before your successful exit. So it's never too late to do it. Obviously, the sooner you begin to build value and mature the business, the more benefit there is. But, you know, there's always an opportunity to do that, except perhaps in that last, 6 months to a year, you might still exit, but you're going to kind of get what you're going to get. So what does a plan look like? This is the EPI sort of standardized methodology. A lot of people in the industry use this or some variant of it. And I'm just going to walk you through it in high level because it's a fairly powerful tool. You can break it down into 3 steps. As we see, the first step is what we call the discover stage. And this is an assessment stage where you'd be working with an exit planner, you'd be working with your financial advisors and other advisors. And really what you want to do here is assess the personal, financial, and business situation. Do you have those things in place? Have you given thought to some of those gaps that maybe you haven't filled? And then we would help you conduct an annual business valuation using the model we showed and an assessment of where the business sits. How attractive is it? How ready is it? And from this, you can generate basically a prioritized action plan. So, okay, in order to take me from where I am to that potential future that, you deserve, and why wouldn't we help you get it? Here's a bunch of stuff that I need to do. You'd move into a 90-day cycle of what we call preparation, where you'd be working again with your team of advisors on filling in those blanks, right? Transferring value, establishing your personal affairs. Some of these things have a timeline that's required, and working in the business. What I really like about this model is it kind of matches a natural rhythm that many of us have, which is about 90 days. If you try to plan something 12 months out, you find generally that after about 90 days, you kind of lose focus and the energy goes down. So by re-injecting every 90 days, you maintain a certain a positive momentum. At the end of every 90 days, you would review your plan, do a bit of a proof assembly, the things that have been done. And then this is an important decision point. Do I continue to grow, or am I ready to trigger the exit or transition process? If the answer is, I think there's still some value to be created here, you'd go back, do a subsequent 90 days following the prioritized action plan, which gets updated as you go along, reevaluating the company on those scores so that you can see, hey, we've created $1 million of value here in the first year or whatever, right? So again, it makes some sense. And then ultimately, at some point at the end of a 90-day period, you're going to be deciding, now I'm ready to hit the button. Do I then enact an exit plan, which you would have analyzed and decided on probably what the best fit ahead of time, and then you would move into that exit and then post-exit period. Last concept before we move to Q&A, a winning team needs a coach and a quarterback. Again, I think I indicated that, a team approach makes some sense. The way I like to see it, we need the owner, who is kind of the coach. You set the goal, you pick your strategy, and then an exit planner acts kind of as the QB, right? Calling the plays, we're leading the team down the field. As you move through the process, different advisors are going to come on stream and do their parts, and then they'll exit, and then they'll come back in. having an exit planner to kind of follow you along allows someone to manage the process from start to finish. It's a great way to have someone help like documenting and sharing the info, because again, over a 3 to 5 year period, you know, there's going to be a lot of changes. It's a way to align and coordinate the choices that the owner makes, and then disseminate that information to the team. So we're identifying trade-offs, and then it's a way to minimize that wasted effort. The last thing you would want is your tax advisor to spend a bunch of time devising a fantastic tax strategy, only to find out that because you want to exit in a different direction, that's no longer, you know, of much value, and they have to start over again. So again, having kind of that central player to work with the owner from step to step is having your QB or your director or your project manager, whatever you want to call them. All right, so that is the meat and potatoes of what I wanted to share with you today. Amazingly, I'm on time. That was probably a lot of information. We are recording the session, and the session will be made available to everybody, so you can re-listen to it at your leisure. But now I'd like to move into about 10 minutes of Q&A, and then we'll just have some closing remarks, and we will be on time. So thank you. Mark, do we have some questions here?
Hey, Jeff.
Yeah.
Brad here. Excellent presentation. Thank you very much.
Oh, thank you.
I'm curious, from your experience, what's the trigger most commonly to get business owners? Because, you know, the data you showed said most of them don't have a plan. As a matter of fact, you know, 8% have an actual real plan.
Yes.
So for the 90% that don't, what's the trigger to get them moving, do you think? Or what do you see?
You know, I'm really glad you asked that question, because I think that's the $1 million question in our industry, and a lot of advisors are asking, because so many of us know the reality, and it's a question of how do you get people to take action. And I honestly think it's raising awareness. And what I really like about this methodology, because it's not different from what I used to do with my old partner, which was the value creation, is if you can tie it to that value number, right? If you can demonstrate credibly, and I think we can do that because we got the tools to say, hey, look, the business is worth this right now. If you've got an estimate of what you want to do and how much you think you're going to need, if there's a gap there, you need to fill that gap. Now, if somebody was in the enviable position where they need $6 million and their business is already worth 10, you'd say, well, you know, your exit plan is kind of baked in. You just got to maintain the value. But it's giving them that impetus of, there's going to be things that I want to do. I maybe haven't had a chance to think about it, but when I do, I'm going to see that, okay, this isn't going to happen magically. And when a buyer looks at my business objectively from the outside, they're not going to necessarily see what I see, because it's my baby and I love it, and I know all of these internal things. So having a bit of that sobering wake up call, I think is probably going to be the number one thing to get people certainly considering it and hopefully moving to secure their future.
Jeff, I think we can switch it to away from the sharing of the screen, and so we can actually see.
Yeah, good point.
There you go. We had more comments than questions, so.
Okay.
Positive questions.
Hey, Jeff, I'm wondering.
Yeah.
Yeah, I was just going to say, I'm wondering with the current rising inflation rates that we're seeing, probably going to see some business owners maybe potentially getting even harder to get loans or higher loan rates. Any impacts you're seeing right now in the valuations that's coming down of these businesses? The EBITDA is being reduced just into the current market right now compared to, say, like a year ago?
I have not seen that personally. I think you're probably in a better situation. I mean, I think that would make sense.
Yeah.
I think broader than that, though, is you know, I don't know, you're probably like me, you drive around and you see there's a lot of businesses that used to be there that are not there. So I think we've had that economic downturn, and then COVID, and then, you know, the interest rates. I do know, I just recently read a stat. PwC did something, and like 37% of owners that they interviewed said they would like to exit their business right now because they have fears about these things and then staffing, but they just don't feel that they're in a position to do it. And so I think there's a lot of folks there that are kind of hanging on and seeing the stuff you're talking about coming down the pipe and probably quite worried about it. Yeah, it's a good question though. Thank you.
There's a question, Jeff, external business valuations on some sort of regular frequency. Is this a recommended best practice for business owners? A sale isn't on our immediate horizon, but we want to start properly starting and prepping for that possibility.
I would say that having some order of magnitude valuation on a fairly regular basis makes sense. And that's why I like the approach, kind of the M&A type approach, because it's reasonably quick to do. Detailed valuations can be time consuming, and they certainly have their place in certain conditions, but I don't know that I would necessarily, you know, spend money on a full valuation on a regular basis. As you start getting closer to putting some hard numbers on it and working with an M&A or a broker, then obviously at some point that more detailed valuation makes a lot of sense. But I think just having that kind of strategic high level value probably is a good starting point. And yeah, I'd probably look at doing that maybe once every 12 months, you know, as you're implementing changes to make sure we're on the right track, we're seeing some benefit there. I don't know, maybe there's some valuators on the call that have a different opinion and they're thinking, no, yeah, you got to do it every 6 months. But I say once a year at a strategic level is probably, you know, for exit planning, good enough.
Well, how much does a valuation on average cost for a full valuation?
I haven't, you know, when we used to do them with clients, when we were doing what I call late stage exit planning, I seem to recall, you know, about $5,000 is maybe an order of magnitude number, budget number, depending, of course, on how complex it is. And, you know, the thing about valuations is there's a whole bunch of different ones. Like if you are valuing for transition to family, you're probably not looking to maximize value. It'd be different than if you're trying to sell to a strategic buyer. If you are regrettably caught in some kind of dispute and, you know, you're triggering the unanimous shareholders agreement because of litigation, then there's usually a formula that's fair market value. So it kind of depends on what the valuation is for. But, you know, about $5,000, I think, is maybe a good starting point. You know, what I'll do, we're going to put the questions and share them. I'll talk to a few valuators that I know in my network, and I'll get a better number for people.
Yeah, Jeff, just to echo that, I agree. It's 5,000 is kind of like a starting point, quite frankly. And again, it all depends on the level of complexity of the assessment being done, because there are quick thumbnail ones that cost a lot less. But if you're doing an actual formal valuation for, like Jeff said, litigation or for an actual sale just to support something to Revenue Canada, then the cost is going to be more expensive because it's a little bit more in depth.
Jeff, another question came up. What are your thoughts on partial sales and then later on complete sales as a transition to exiting?
Ooh, what are my thoughts on that? First thought is, I guess it depends on what you want. It's certainly, you know, one of the standard of our 7 options. And I think it can make a lot of sense. I mean, it depends, again, if an owner is really wanting to get out of there, it's probably not a good choice. But if you still feel you've got you know, some horsepower and you're looking for an injection of capital and maybe some new energy, or if it's just a strategic opportunity to bring people in, I think it's definitely a kind of a common strategy, right? The colloquially, as we say, you know, taking some chips off the table, so you get some of the value out and set it aside, and then it can continue. So yeah, definitely a viable strategy, depending on where you're at in kind of your timeline and your bigger picture, I think.
Can I throw in one in on there, Jeff?
Yeah, please, Brad.
Yeah, because actually I've had a couple of clients who had weak leadership teams. So you've got a CEO, principal owner, but shared ownership. And when we looked at the strength of the senior leadership team, it made the business unsellable. So they had kind of negotiated in a couple of deals that had fallen through, and really the strategy that made the most sense for them was to actually do a merger. Plus, in their industry sector, the guys who were doing the acquisitions, the guys who were doing the buying, weren't looking at anything less than 50 million. So you couldn't get on the radar of the people who were paying the big multiples if you weren't, at least at that value.
Right.
So the only way to get to that value, and because there are a few other similar types of companies, a couple of their competitors actually, and you merge three of them together, and then suddenly you've got something that A, gets on the radar, and B, one of their competitors had a much more aggressive, more powerful leadership team.
Right.
And so to get the best deal, it was actually what I call a deferred sale. So it was a merger, kind of reconsolidation in terms of the integrated company, and then a sale.
Yeah. Well, thanks. Yeah, thanks for sharing that, Brad. And I think it just speaks to what we've been talking about, which again, you're not going to be able to access those options unless you are, looking at it ahead of time, because obviously that wasn't something that was achievable, on the turn of a dime, right? That was so that, the sooner you begin to work through the process and come to those conclusions and say, wow, okay, so, we need what we thought might be our workable strategy isn't going to work just because the market's not supporting that. Now we need to pivot and assemble something that is going to work, and not just a time and preparation thing. But yeah, thanks, Brad.
Well, actually, they learned it the hard way, because the deal came at them and the deal failed. And then that was the reality check for them. That was the trigger for them that, holy shit, we actually really have to do this right, or there isn't going to be an exit and we're all in trouble.
Yeah, exactly. Yeah, nothing like reality sometimes to smack you in the face and realize, wow, okay. Excellent. Well, we're coming up on the end, and I just wanted to make a couple of closing remarks. If there's a couple more questions, I don't want to cut people off. Obviously, there's always the opportunity to send me an email or give me a call, if there's questions that haven't been addressed. But I do want to respect people's time. So why don't we switch over just to the closing remarks, and we'll get everybody on their way. Unless there's is there one more burning question? Someone's like, if I don't get this answered, my day will be ruined. We'll take a burning question. No? Okay.
No, I think you can carry on.
Safe to go, eh? Okay, excellent. All right, well, let's talk just a little bit about what are some of the potential next steps that you could take. So what now? So there's a couple of things. So on my website, I have a 10-question exit readiness quiz that, again, kind of addresses a bunch of the parts that we talked about, the three legs of the stool. And it's just it's a good starting point to get your thinking kind of activated. So you can either go to the main site and go to the I want to exit button. You'll see take the quiz, or you can go straight to this / are you ready? It'll take you right to the quiz. You don't have to even put in your email address. You get a score and then some recommendations on next steps. So that's certainly something that you could do. And then going forward, you can reach out to me for a free 30-minute discovery call. No obligation. It's an opportunity to ask some more questions. Maybe you explore a little bit, your personal situation and where you think that might be a fit, and then just see if there's some place to go from there. So you can certainly do that. I'm also obviously at your disposal, in terms of giving me a call or shooting me an email. Love this stuff, so certainly happy to talk about it. Recording will be made, and we'll be sending it out to all of the attendees in the next few days here. And I really want to thank you for your time this morning. I know, like everybody else, time is always at a premium, and especially people who are running their own business. So I really, really appreciate you investing an hour of your time today. And hopefully there was some value for you. And I would be very happy to, like I say, connect and chat.
Okay, Jeff, I'm going to stop the recording right now.
Okay, sounds good. Look at that.